Welcome to session. Today we will discuss shares and dividend. For this chapter, basic understanding of the types of ownership of business is required and the terminology used while trading shares. Basic awareness is required, nothing too complicated. So, if you see the screen, here we need to deal with three kinds of ownerships. The first one is sole proprietorship. Just hold on. Let me pull up the PDF for you. Okay, so the first one is sole proprietorship. When the business is comparatively simple and the investment required is also not too large, so an individual or a family can own it. Even when a family owns it, it is the head of the family that owns the business in his name. So sole proprietorship is a single person owns the business. Entire 100% investment is made by that single person. Whatever the risks and rewards are there, those the single person is responsible for them. So if there is any liability, he has to only bear. All his personal assets would be attached. So there is no limited liability in sole proprietorship. If he ends up in losses, all his personal assets would be attached. And the kind of business is also simple, where a person in the know-how of any single person is sufficient to run this business. Any small kinds of businesses that you see around, those are mostly sole proprietorship. The second one is the partnership. When when a business is slightly complex, where the amount of investment is also not too low, but it is considerably large, such that a single person cannot make such large investment, then two or more like-minded individuals come together, they enter into a contract, and then they bring to table their individual expertises and their own investments, and together as partners they run this business. Their liability is limited to the amount that they invest as a partner. So if the partnership ends up in losses, only the amount that they had contributed as a partner would be confiscated, but their personal assets are not attached. So this is partnership. Here the business is run by partners as per the contract they had entered, and the total investment in such a setup is larger than sole proprietorship, but comparatively it is less than the public limited company. So let's see what is the third type. When a business is very high end, where the expertise required is is large, and even the investment needed is too high, where few individuals cannot make such investments, then a few like-minded individuals, they do a research and they plan everything, and then they go to the market and publish a document called prospectus, where they will showcase to the general public saying, this is the line of business we do, this is our plan to run the business, these are the potential profits that we can earn. So they will showcase their business venture. If the general public is interested in their line of business, and if they are convinced that such a team would be able to generate profits, then they buy individual units of individual units in such a business. Such a business is called a public limited company. Here the general public are the owners. Like, it is not owned by few individuals. Whoever is holding even a single share in such a company would be one of the owners. Like, the whole company is owned jointly by the set of investors. If you see here, suppose if we envisage such a company, to set up such a company, and we need a capital of say 1 crore, okay, and we intend to raise this capital from stock market, and the number of shares that we wish to constitute is about 10 lakhs. Then the total capital by the total number of shares that are being issued, this gives you the nominal value of each share. So capital is the total funds that are required to establish and run such a business. So it is very high. For example, here we took it as 1 crore, but it could even be billions of rupees. So here, when we try to raise a capital of 1 crore by issuing shares, 10,000 shares, 10 lakh shares, then the nominal value of each share is 10. So if a person buys a share in such a company, he will be issued a share certificate where the worth of each share, the 10 rupees, will be mentioned in that share certificate. So this is called the nominal value of the share, or share value, or it is even called face value. Okay, these terms are essential to solve the numerical problems. So pay attention to the terms being used. So when the shares are initially bought, the first investor will buy them at nominal value or face value or par value. Uh, so so these shares subsequently will be traded in a stock market. So the prevailing price of such a share of such a company, see, initially they bought it for 10 rupees, but as on today, the share, the price in the prevailing price in the market could be high or low. So this prevailing price in the market, it is called as market value. Okay, so first it was nominal value, the prevailing price in market is market value, and these are the terms that are used. This is the jargon that is used when they say a stock is bought at par. That means its market value is same as its nominal value or face value. When they say a stock is bought at premium, that means the market value is more than its nominal value or face value. When they say a stock is bought at discount, then that means the market value is less than the nominal value or face value. Okay, so such a public limited company is governed by regulating authorities. The investment, buying and selling of shares would be governed by stock exchange authority, and the daily running of the business would be governed by the company law. That is, the government will make such laws. So a public limited company, the investment involved is pretty large, and it is called capital, which is raised in the stock market, and each individual unit of such an investment is called share. When an individual or a person buys one single unit of investment, then that is called a share, and a share certificate is issued by the company in the name of that individual. The price that is mentioned in the share certificate is called nominal value or face value. This share might command a different price in the market depending on the performance of company. That is called the market value. So when the shares are bought at par, market value and face value are same. When the shares are bought at premium, the market value is greater than face value. When the shares are bought at discount, market value is less than face value. Okay. So these are the some of the formulae that might help you in solving the numerical problems. So the number of shares held by a person is given as ratio of total investment by investment per share, or total income by income per share, or total face value by face value per share. So if you want to know the total number of shares held by a person, these three ratios would be helpful, and they are all equal. So total investment by investment per share, total income by income per share, total face value by face value per share. So these ratios are same. So when a company is run for an year and it generates profits, so this profit is distributed proportionately among the shareholders. So if a person is having just one share, he will get a proportion equivalent to his investment, proportion of profit equivalent to his investment. If another person holds 1 lakh shares, he will get profit proportionate to his quantum of investment. So this profit that is shared among the shareholders is called dividend, and the company declares dividend as a percentage of nominal value of the share. Okay, so dividend is declared as always percentage of nominal value of share. Suppose a company is saying a dividend of 1 rupee per nominal value is being declared. So if the nominal value is 10, so for each 10 rupees invested, they will get 1 rupee. But this 10 rupees is the nominal value, not market value. That should be noted here. So how do you get the total dividend of any shareholder? The rate of dividend, which is expressed as percent, sometimes percent of face value. So rate of dividend percent divided by 100 into nominal value. So this is the dividend earned per share into number of shares will give the total dividend earned by a shareholder. So what is meant by investment proceeds or sale proceeds? Suppose an investor is holding 100 shares and he goes to the market and sells his 100 shares at market value. So whatever the amount that he is getting from the market, that is called investment proceeds or sale proceeds. So how is it calculated? So the number of shares that are sold by the shareholder into market value, this will be the sale proceeds. Now the last term is yield rate or rate of return on investment, or it is also called as money's worth. So suppose a shareholder got a particular quantum of dividend on his investment. So how is that yield rate calculated? So the total investment, that the total dividend that the shareholder got on his investment by his total investment made as a percentage. So this will give you the yield rate. So the what, in other terms, what you mean by yield rate is the money you are earning as dividend per each rupee. So total dividend by total investment into 100. This expressed as percent is yield rate. So yield rate helps in comparison of investments. So if you have an option like should I invest in company A or should I invest in company B? So if company A dividends declared are percentage is more, and if company B dividend percentage is less, what they declare. So you will calculate the yield rate. If the yield rate is more for company A, so this is better investment. So yield rate helps you in comparing your investment, how the investment is performing at various. So this is a pretty simple theory behind this chapter of shares and dividend. So we will look at worked examples. Thank you.